countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's Thursday morning, which makes it, for this week at least, the last trading day for the week. Tomorrow, of course, is a market holiday. Overnight, lots of action, mostly on the downside, though. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Budmi, my colleagues Nigel and Surabhi. Guys, hi, morning.
Hi, morning. And there's some happy decoupling because Wall Street was on the downside, but Asia is fighting back. Asia is on the upside. Got a 3-day weekend ahead, and I think Sunday is going to be special for Nigel, waiting for all the Easter festivities as well.
We're looking forward to the long weekend, and Easter for me as well will be special. But we've got our hands full this morning, right?
Yeah.
You've got tepid global cues. The Nasdaq pulled back a goodish bit. Powell's comments is something that we need to take on board as well. But as Surabhi said, Asia is not looking too bad, and India has been outperforming. Let's hope that continues.
Absolutely. And so the Powell comments were front and center, and we will play out exactly the sound bites. But it was pretty cool. You had the former RBI governor, Raghuram Rajan, sitting down with the current US Fed chair, Jerome Powell, and there was that Q&A which happened. There was a speech, and then, of course, there was a sit-down fireside chat. So this is essentially what Powell said. The Fed is not in any rush to cut interest rates. That was broadly the message, in one line. And as I said, we'll play out sound bites, etc. So the market kind of read it to mean that there is no Fed put. And it doesn't look like there is a Trump put as well with regards to stock markets, maybe for bond markets, yes, but not for stocks. And of course, we have the Fed chair now saying that he's not in any rush to cut rates, both on the employment front and the inflation front. I mean, the dual mandate for the Fed, they're not very clear what to prioritize on because things are in a bit of a flux. And of course, he also kind of spoke a little bit about the impact of tariffs on higher inflation, slower growth, etc. I mean, of course, all of it pointing to a slightly tougher environment macro-wise, and markets did pay attention. So, the S&P 500 hit an intraday low near the 5,220 level during the Powell speech and ended the session at about 52.75. And now, one big reason why I think the markets behaved the way they did, of course, the comments mattered, but liquidity was thin. And that accentuated the price action on the downside for US. And the reason why, of course, liquidity is thin, of course, is the fact that, it's a holiday shortened week in the US as well. In any case, after the massive volatility up and down, people were not very sure what to do. So liquidity was running a little low as compared to the last 30-day or the 6-month average. And of course, yesterday was particularly the case. So the changes, you must keep in mind that it was a slightly low volume session. Many countries observe holidays, India included. That is tomorrow. Of course, the US as well, Good Friday. Friday to Sunday is the long weekend. And I think, this thin volumes is going to be a factor for most markets. Macro markets, 10-year yield was down about 5 basis points. Dollar index about 1% lower, 0.92 lower. And of course, oil prices came up a little bit. We're back at about $66 on the Brent for oil. So just to kind of tie in the levels, really, you basically have the support for the Nifty, which comes in at the 40-hourly exponential average. 23,030 is that number. The resistance zone, the important resistance zone, which we put out yesterday in the afternoon as well, 23,650 to 23,870. That is the zone for the Nifty on the upside. Bank Nifty support, again, comes in at the 40-hourly, which is 51,690. And the resistance here comes in at 53,650. We've had massive moves last few sessions. Tuesday was great. Yesterday, that is Wednesday, was very, very decent. And of course, we have a bit of a knee-jerk reaction in Wall Street on the downside. We perhaps react to it a little bit, but remember that point about low volumes, in a way, sort of exaggerating price moves as we go into the 3-day weekend. GIFT Nifty will come up on your screen. Gives you a quick sense of how we're likely to start. Not bad, about 50 points in the red. Surabhi.
I wouldn't be surprised if this also changes, and by the time we open, we see a little bit of green, just because Asia is so strong this morning. Asia is completely shrugging off the declines on Wall Street. You could argue part of that is in the price, because this NVIDIA news hit us yesterday. We knew that Nvidia was down in after hours, so a lot of the Asian markets were already reacting negatively. And for whatever reason, for whatever it's worth, Asian markets are not, getting too perturbed by Mr. Powell's comments, where he's basically saying that he will be waiting a while longer before deciding on the future course of policy action till there is more clarity on what's happening with inflation. For the time being, actually, the rise across Asia is looking very, very smart. The Hang Seng is up 1.25%, as we can see on the screen there. The Japanese market is up about 0.8%. Singapore is again higher by almost close to 1%. Korea this morning has left interest rates unchanged. So there's, a lot of policy action underway in Korea as well. On Japan, I just want to talk about the fact that now it's all about negotiations. And maybe that's another reason why markets are higher. They're holding on to hope. Major Asian economies are all geared into this negotiation phase with the U.S. And this is what Trump said after the meeting with the Japanese delegation. He said it's been a great honor to have just met with the Japanese delegation on trade. Big progress. So let's see what eventually comes out of it. There's export-import data out of Japan this morning, which is, telling us that the tariff issues are beginning to hurt, because if you look at the export numbers, the growth is only 3.9% in March, which is substantially lower than February's number of 11.4%. You could also argue there was front-loading ahead of all this tariff drama. And remember, in March, the steel and aluminum tariffs, they had kicked in. But the rest of it and the whole Liberation Day situation is, of course, going to show up in April numbers. In South Korea, also, apart from the fact that there's been no change in monetary policy stance today in the rates today, the South Korean finance minister is all set to visit the U.S. next week. He's all set to meet up with Scott Bessent. So South Korea is doing its own share of deal making. That's going to be in focus over the next couple of days. Today, because the dollar in general is trying to pull back from beaten down levels, a lot of Asian currencies are fairly weak, which works well for these exporting economies. The yen is actually leading the declines. It's down about 0.5% versus the USD, but the South Korean won, the Singapore dollar, all these currencies are lower versus the USD. The DXY, of course, is trying to make some sort of a recovery towards the 100 mark again, which is why I'm saying that maybe by the time we start off, we might see some of this Asian positivity rub off on us as well. The flows picture has been very, very solid. Yesterday, again, we had FPI buying come through. FPI has bought stocks worth almost 4,000 crores in the cash markets. Domestic institutions have been unloading. They've been lightening positions, sold off cash equities worth about 2,500 crores. Beyond, of course, all the global headlines, it is earnings season, so lots of stocks in focus, earnings and non-earnings. I'll leave you with just three ones. Wipro. Numbers are weak. The guidance is extremely weak. Wipro is telling us that in the first quarter, the top line could actually decline by 1.5% to as much as 3.5%. And why is that? In the Q&A, Mr. Srini Pallia actually mentioned that. He went on to say that there are delays in decision-making and transformational deals as well as discretionary spends could be hit. So watch out for Wipro. The margin picture is actually good. Margins are in line with estimates and they've not fallen. Paytm, Vijay Shekhar Sharma is going to be foregoing about 2.1 crore ESOPs, but this is not out of goodwill. This is because they're settling with SEBI, finally putting to rest that ESOP matter that has been pending, with the regulator saying that as a major, decision maker and promoter of the company, you cannot be holding ESOPs. And he said he's not going to be taking on any ESOPs for the next 3 years. So Paytm in focus. And Angel One, just an example, when the market hurts, so do companies linked to the capital market. This space has done very well, but the numbers in quarter four for Angel One are extremely weak. So watch out for this stock as well. But Nigel, overall Asian Q is not too bad.
Well, that's right. It's going to be a test for the bulls. In the last three trading sessions, the Nifty on a day-to-day basis has ended at the high point of the day. We have a long weekend that's coming up. So today, that's going to be a bit of a test for the bulls. We have the Nifty weekly expiry that will play out, which will add some bit of volatility. And also overnight, the US markets, well, they were under pressure. Particularly, the Nasdaq was down close to around 3% or thereabouts. But it's a good time, actually, for the FIs to turn buyers. And in yesterday's trading session, we did see, they bought close to around 3,000 crores odd. Getting into this particular, getting into this series itself, there was an arbitrage that was going on. That was, they were selling in the cash market and they were buying in stock futures. Now, in fact, that seems to be turning around, because in yesterday's trading session, they sold stock futures and they bought in the cash market. So there's a bit of a reverse arbitrage that's going on as well. And the domestic flows, remember, they have come down a little bit. So domestic flows on a month-to-month basis, they did slow down a little bit. This is the core equity domestic flows. Though you need to keep in mind that the industry is sitting on ample amount of cash, close to around 6.7%. It's moved up by around 60 basis points, and the industry cash levels are at the highest since 2017. Net, it's a good thing that the domestic investors, domestic mutual fund houses are sitting on a good amount of cash, and the FIs have turned buyers as well. What about their positioning on index futures? Well, their net short, close to around 87,000 contracts on the short side is what we have seen. The long short positions as well, 72% of the positions are on the short side. Moving to Nifty options data. Well, we have, the 22,450 call that was fairly active. 20 lakh shares getting added out there. Premium at around 57 rupees, which gives you your resistance zone. That's around 23,500 to around 23,550 odd. Important resistance zone up here. While the 20 DMA, that becomes the first reference point. Today, the bears will be counting on this level holding out. If you can get past this level, we'll see a bigger fillip towards the end of trade. And the Nifty Bank, well, it's got its work cut out. Last few trading sessions, it's been doing well. It's only 2.5% away from those 52-week highs. The Nifty is still a distance away, close to 11% away. And in the last 1 month or so as well, you've seen that the Nifty Bank is up close to 10%. Well, the Nifty is up only around 5% or thereabouts, telling you the kind of, outperformance you've seen out there. And today's, the IT indexes like to be under pressure. Wipro's numbers weren't great. There's a bit of a, feeling that Infosys is going to be a little tepid as well. And the Nasdaq was down. So the heavy lifting will yet again have to be done by the Nifty Bank.
Okay, all right, absolutely. And banks have really risen to the occasion, so bulls will hope that continues today as well. Let's get you the equity call of the morning. Lawrence Belanco of CLSS says that following last week's market volatility, they see the majority of global and regional markets attempting to consolidate in new lower trading ranges, where the April 8 to 9 lows are now seen as support levels and the early March lows seen as resistance. He says the Nifty remains resilient, with the NSE bank sector providing leadership. And the stock level, he says they would be buyers of HDFC Bank. That's the HDFC Bank ADR, ICICI Bank ADR, as well as Bharti Airtel.
Okay, well, let's play out those sound bites, right? This is Fed Chair Jerome Powell at that conference, that economic conference overnight, which made all the headlines.
The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs. Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans.
All right, that was Fed Chief Jerome Powell, and markets pretty much selling off as those comments played out. Okay, so what's the global equity setup and the Asian equity setup in particular looking like? Where do we fit in terms of the Indian market? Florian Neto, Head of Investments Asia at Amundi, is with us now for some perspective. Florian, so good to have you on the show. Welcome to the program, and it's good to connect again. So much has happened in the last 1 month. It's been absolutely crazy and chaotic. But now as the dust begins to settle and as Asian countries are busy negotiating with the US, when it comes to Asian equities, what's your call? What are you buying? What are you avoiding?
Well, thanks for having me this morning. Good to be on the show with you. It has been hectic in terms of news, and overnight again. Yesterday we got news on NVIDIA. All the semiconductors in the region have been selling off. But we see a bit of resilience those days within Asia equities. Definitely, if we can take a step back and look into our preferences across, we did sell a bit of equity at the beginning of the month because the volatility was too elevated. But where our exposure is going today in terms of overweight is we try to find some shelter in domestic and defensive stories. So India is one. We are close to the max overweight we have been on India. It's our preferred country so far. We like China A, we like Philippines. So basically, we wait for the dust to settle before potentially reloading. At the end of the day, so at the end of the 3 months, so-called 90 days pause, we will look very much into the relative tariff, because it will be a key feature as there are large export overlaps among Asian countries. So today, we are slightly lighter on equity compared to 1 month ago, and we have been changing a bit our allocation. We did start increasing India at the beginning of March, and we have been adding up to China A, fine-tuning, reducing a bit Korea and Taiwan of late, because they will be quite exposed from an export point of view so far. So this is how we are positioned from an Asia equity point of view.
Florian, great speaking with you. Prashant here. Could you give us a sense of what you're doing in India specifically? Between the common consensus view is large caps are more reasonably placed, mid caps, small caps are more still expensive. So just give us what Amundi is doing.
Yeah. From the consensus, we are not that far eventually. From a valuation point of view, I think one of the big headwind for India equities over the last 6 months was that foreign investors were perceiving India as being in a frothy valuation type of environment, and we got 2 quarters in a row of slightly weaker reporting. The last reporting season has been quite strong, actually, delivering 14% compared to Q4 24. And we've seen that financial, healthcare, communication has been delivering quite substantially. So the way valuation, yes, are not cheap in our view, 20 times. So you have to pay 20 times for quality today, very, very good profitability in general versus other peers in the region. So we're happy to step in on large cap. But for small and mid cap, as you mentioned, we do believe they are still a bit more expensive in our view. Then in terms of selectivity at the stock, at the sector level, our preference is going for banks, and you've been mentioning just before the interviews that banks have been skyrocketing. Indeed, banks have been outperforming. We are still committed to it. We like hospital. We like a food delivery platform as well. So we are selective in our allocation. We have another weight on India that is coming from bottom up, actually, preferences. But we do feel that it's a bit too early to step in on the small mid cap. At the end of the day, in terms of EPS, we are expecting earnings this year to be slightly lower than the consensus. The consensus is around 16-17%. We still have a solid double digit, but more around 11% today. So no big issues in terms of EPS, still good. Slightly lower than the consensus. We prefer large cap. We are still selective in terms of sector, and we do feel it's a bit early to go to small and mid cap.
I did mention that, Florian, that the Nifty Bank has been outperforming, and good to hear your thoughts. You're sounding reasonably optimistic on the Indian equity market prospects. My question to you is, what about the mother market? The US markets were the only game in town till a couple of months or so ago. Most of the flows were going out there. That market was doing well. Now the call is that maybe, in fact, the US markets have hit a near-term peak. Do you believe that's the case? And if that is the case, can the Indian market still outperform? Emerging markets like India, China, can we still outperform from here on?
Yeah, it's a good question. I think the big difference compared to when the US stocks was under pressure, and this is why history may not be actually very much of a help in this kind of environment, is that it's very unusual to see euro moving 2% up when the US equity is down 2%. So we do see that the dollar is now not behaving like before as a safe haven, but the dollar and some US assets are behaving a bit more like emerging type of reaction function so far, because there is a question mark on the US administration, and there is a question mark as well on where the US is eventually going. So we do believe that US stocks will eventually do okay this year, but we don't think it will outperform the rest. So in this environment, it's still shaky for the US, but we do see earnings per share to be coming in. The big question mark here is where eventually are we going on the tariff side? As of today, we are in a pause for 3 months. If the reciprocal tariff are reinstated, our calculation from a credit spread point of view, from a dollar point of view, from a growth in the US point of view, leads to a close to recessionary level on the profit side. You don't need to have an economic recession to have almost no profit in the US. If it's the case, then it's a bit of a bear case scenario where eventually S&P will not move up significantly from here. We don't think it's a base case. We think that eventually the average tariff effective will be lower than what we've seen on the 2nd of April, and a lot of countries are now front runner. India is one, Japan is another one, front runner to have a bilateral deal. So in our view, US will perform okay. We'll rebound a bit from those levels. It doesn't mean that we cannot have a small leg down from there, but globally, when we look at our stock toward the end of the year, we do think that the S&P will be higher than what we are today, and we see that there is a bit of a decorrelation between what's happening in the US and what's eventually happening in emerging markets and in Asia more specifically.
Sure. All right. So, Florian, quick last question in that case. And that's an interesting call that you're eventually, once we get through this all, you're seeing the S&P 500 higher by the end of this year. Quick last call. When you chat with your peers, when other money managers around the world, your counterparts in US, in the run-up to Liberation Day, money was really moving to Europe in a big way. Money was still not coming to Asia. China had its own problems. India was being, called overvalued. We've seen a little bit of a change in the pattern of flows. We're suddenly getting more foreign flows. Do you see a bigger wave of liquidity coming to Asian emerging markets at all?
Yes, I think the big shifts that we've seen since the Liberation Day is on the rate side. So we do see that Asian rates now are a good alternative to US Treasury. And we've seen a lot of investors, being institutional, sovereign wealth fund, public pension fund, that are looking to alternative to the US Treasury. If the US Treasury is, and we see the steepening of the curve as fast as we've seen last week, for example, they want to find shelter. And the good news is the Asian rates have been actually having a very low beta to the US sell-off last week. Why? Because eventually the inflation issues that we have in the US, and we've seen Jerome Powell mentioning about this in your show just before, we don't have the same inflation issues in Asia. Headline inflation in India has been coming at 3.3, quite lower than the threshold of 4% from the RBI. And it's not an India story. It's the disinflation story is in Asia. So we like Asian rates, and we see that investors are turning a bit more constructive on Asia rates. When you hedge yourself, when you go on Korean curve, on Chinese curve, and you hedge the currency, you're actually having a higher carry than in the US. And we do believe that the central banks in the region have a I would say, are less in the corner than what the Fed is facing today with potentially stagflationary environment. Growth will be slightly lower. Inflation will be slightly lower in Asia. FX is still relatively resilient because the dollar is in a bit of a free flow. So at the end of the day, we do think that there will be more cuts in the region. Central banks will turn more accommodative, like RBI turned officially last week. And we expect more cuts, though Asian rates is where we do see a lot of flows coming in, on top of what you have been mentioning about European equities, for example.
All right. Thank you very much for joining us. It's a pleasure, and I hope this is the first of many interactions here on CNBC TV18. Good to get that take. Well, we'll take a quick commercial break here. We're going to come back in just a bit from now, top 10, with our research team coming up.
Welcome back. Let's straight away talk about the stocks that should be on your radar as well. Our team is standing by with a list of top 10 stocks to watch. We'll, of course, start off with what else but Wipro. A bit disappointing, Rima?
Q1 guidance disappoints. The company is guiding for minus 3.5 to minus 1.5% for the June quarter. The company says this is on account of the rise in uncertainty, which has led to the clients becoming more cautious. They also said clients are taking a more measured approaches when it comes to transformational projects and discretionary spends. And in the press conference, they also gave examples of how, one of the large transformational projects got paused and that impacted growth. That said, the Q1 guidance was disappointing. Q4 revenue was also lower than street estimate, declining by 0.8%. But the company did well on the margins. They managed to defend margins at 17.5%, and the deal wins were very, very strong. Morgan Stanley, Bernstein have an underweight call on Wipro. UBS, though, on the other hand, says that they see limited downside from here on. The pain that the IT industry is witnessing is more temporary. It's not structural. And any signs of a recovery in discretionary spend will result in a recovery in the PE multiples. So they've got a buy call on Wipro. But for the day, the ADR was down, it's more than 3% overnight. I'm going to go with red, given the muted guidance.
Okay, all right, Rima, thanks for that. Well, remember, we'll connect with the management of Wipro at around 8:35 a.m. later today. But let's focus on a couple of other results. Angel One's the stock on our radar. Upasana joins us to tell us how they were. Upasana, take it away.
Good morning, Nigel. Well, the company has reported a weak set of numbers. It is a sequential decline across board. Now, higher operating expenses has led to the decline in margin and profitability. Company's cost to income stood highest in Q4 in the year at 71.6%. Now, coming to gross client acquisition, they also slowed down and saw a degrowth of as high as 22.4% in this quarter versus 30% growth in last quarter. Now, talking about total client base, it saw an uptick of just about 5% on a quarter-on-quarter basis. And company's market share in equity, F&O and commodity also declined, barring cash segment, which saw an uptick of nearly about 20 basis points. Now, coming to the numbers, revenue saw a downtick of 16%. This was mainly impacted due to 21% fall in company's net broking income. Order volumes, which is a key revenue driver, also fell by 23%. Company's margin saw a downtick of 680 basis points, stood at 32.5%, and PAT saw a downtick of as high as 38% sequentially. Now, company's average daily turnover also saw a downtick of nearly about 20%. Now, company says that the FY25 performance subsums regulatory changes and even softer market conditions. So, all in all, going with the red.
All right. Thanks very much for that. Angel One in focus. Let's talk about 360 ONE Wealth Management. Nimesh is joining us now. The news has come, but Nimesh told us first, as part of his chatter, that there is a strategic announcement coming, and it indeed is a strategic investor who's coming into the company, Nimesh.
Well, Prashant, looks like there's going to be a strategic investor who's going to come in. So the news is that there is a board meeting scheduled on April 22nd to consider a preferential and/or warrant issue by 360 ONE. So it looks like there is going to be a strategic investor. My sense is going to be a sizable stake that a global wealth company is going to buy in 360 ONE. But unlikely that it will be large enough to trigger an open offer. So from a retail shareholder point of view, looks like there won't be a large open offer, so to speak. Interestingly, if you look at the shareholding pattern, one large investor is Bain Capital. They own 23% stake. So need to see as to how things pan out. But looks like on 22nd, you will hear a global wealth management company buying a significant stake in 360 ONE.
Okay, quite interesting. So definitely we'll be keeping that stock on the radar. Nimesh, and thank you for the early alert on this as well. Back to Rima then. She's watching out for Sonata Software and Tanla Platforms. Rima?
Sonata Software has issued a revenue warning for Q4. So they've informed the exchanges that the revenue estimates from their largest client is going to be lower than what they were anticipating, and therefore the international business revenues will not meet what the company was hoping to achieve in Q4. Investor call is on 6th April. The stock is down 44%, but you could expect some more weakness today. Tanla Platforms, on the other hand, has announced that they've partnered with 2 overseas telcos for the deployment of messaging as a platform for rich media messaging. This is the company's first deployment outside of India, will go live in Q1 FY26. They can't share more details on account of confidentiality, but considering the way the stock has fallen, it's down more than 50% from its 52-week high of 1086. You could expect some relief on that stock.
Okay, all right. Thanks a lot for that, Rima. Well, let's go across to Vinny. She's tracking a few names. The pharma company, Glenmark, Prestige, and Puravankara. Vinny, morning.
Good morning. So, starting with Glenmark Pharma, some positive news coming in after the company has launched amphetamine tablets. Now, there are different strengths of these tablets which they've launched, and this is in the US market. They've launched this product. They'll start the distribution coming in from May 2025. These tablets are mainly used for treatment of ADHD. So, yes, important tablet coming in on that front. Market size, when you look at it, the sales data as per IQVIA for Feb 2025 12-month period, the sales data for this drug from other peers was around $422 million. So an important one coming in for Glenmark Pharma over there. Other than that, talking about the real estate names, we have Prestige Estate that's in focus on the back of its pre-sale numbers. Now, Q4 pre-sales numbers, yes, they were good. We're seeing a growth of 48% on a year-on-year basis for Q4. Mainly, this was an improvement in terms of the launches that has led to a good growth is what the management highlighted in their release as well. But overall, for FY25, the pre-sales have missed the guidance. The FY25 numbers somewhere around 17,000 crores. In Q3, they spoke about around a 22,000 target that they had for pre-sales for FY25, so miss on that front coming in. So overall, we could see some bit of a red because the miss in terms of guidance for FY25, mainly because of delayed launches. That is why FY25 was impacted. Puravankara, we are expecting red here as well. Pre-sales came in at 1,282 crores, which is a degrowth of around 34% on a year-on-year basis. Sustained sales was the only thing that supported the growth, and it was a bit of a respite coming in for the company. Collections saw just a growth of 9% for FY25. There was a lot of delays in terms of approvals coming in for Puravankara, and that is why FY25 was not that great a set of numbers that we are expecting from Puravankara, and that is why red on the screen is what we could see.
All right, thank you very much for that, Winnie. Let's talk about BHEL and Dalmia Bharat now. Vivek is here with details. Vivek, morning.
Well, good morning. News flow coming in on both of these names. BHEL, yesterday the company informed the exchanges that they'd signed a technology transfer agreement with Baba Atomic Research Center. They've gone ahead and formed a JV, and this JV will see a technology transfer agreement for electrolyzer systems for hydrogen production. This particular technology will go ahead and aid indigenous development of alkaline electrolyzer systems, a positive development as far as BHEL is concerned. Dalmia Bharat, a negative development, but this particular development pertains to a case that's as old as 2011. So, Enforcement Directorate of Hyderabad attaches land of DCBL worth almost a little over 790 crore. The historical purchase value was at 377 crore. The case was registered in 2011 by CBI, and CBI had made allegations against DCBL regarding investments in a certain entity called as Bharati Cement Corporation, and this was for alleged violation of the PMLA, which is the Prevention of Money Laundering Act 2002. So slight negative, but it'll be interesting to see what is the eventual outcome of this particular case.
Okay, all right. Thanks a lot for that, Vivek. Well, let's do a quick recap of all the top stocks we discussed, the ones with positive news flow. 361 WAM, Thanla Platforms, Glenmark Pharma, and BHEL. While stocks with negative news flow, Wipro, Prestige, Angel One, Sonata, Puravankara, and Dalmia Bharat. Well, we'll slip into a short break. On the other side, we'll connect with Deepan Mehta of Alexa Equities for some fundamental stock talk. Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. As promised, Deepan Mehta, Director at Elixir Equities, joins us on the show. Hi, Deepan. We're going to be hearing out from the management of Wipro in just a bit, but let's discuss the stock. The numbers are a little bit weakish. The guidance is even weaker. The stock, though, has pulled back quite a bit from the recent top. What's your view on Wipro?
Good morning, Nigel, and thank you for having me on your show. The view on Wipro is certainly negative. I think if you see there's a lot of stagnancy in the earnings of Wipro and other large cap software services companies. So even at these levels, it's better for investors to get out of Wipro, go into some growth stocks. I think, that's where the returns can be higher. And you could have a trading rally in Wipro because valuations on historical comparison basis are more attractive. They're certainly cheaper. But generally, when there is no growth, you will not see sustained outperformance. So I would give Wipro a pass, and existing investors should look at lightening up their positions over there.
Okay, so give Wipro a pass, and maybe you'd want to consider lightening up some of the positions. I think we will be playing out the commentary from the Wipro management in just a bit. But just to recap the numbers, the problem is growth. It's really top line. On margins, actually, Wipro has done very well. Margins have been slightly above estimates at 17.5%. But top line, not only have they've missed estimates for this quarter, Q4, but what they're talking about the future, transformational deals, discretionary spends, they will be impacted. One of their transformational deals got put on hold in Q4, which is why that top line number was looking quite weak.
I want to make 2 points. Infy reports today after market hours. So that is that. And second, did you guys see the United Airlines guidance last night in the US? They put a guidance so wide. One is a normal economy guidance, the other is a recession guidance.
Oh, wow.
Poles apart.
Take
so
your
I think
pick.
It kind of tells you the state of affairs, right, in the US. And all these IT companies, of course, are very dependent on the US. Actually, Deepan, listening to the Wipro management, our colleague Rima caught up with the management on, of course, the numbers and the outlook more importantly. Listen.
Overall, we've seen a degrowth at a company level. But having said that, if you look at Americas, which contributes to 63% of our revenue, it grew by 1.2%. APMEA, which had shown a degrowth in the Q4, it actually grew sequentially. I think for us, Europe has been soft last year, and it continues to be soft at this point in time. But having said that, if I have to look at where we are in Europe, we have got a new team. We have also won a large deal. And on top of that, we have a strong pipeline in Europe. And most of the pipeline is around cost, because that's where most of the clients are really thinking around what they should be doing. So if I look at overall macro environment and the uncertainties that are there, what the clients are doing is scenario planning. They're looking at what's going to happen, because every week there is a change, and you got to adapt to that change. So some of the industries like consumer industries, manufacturing, especially automotive and industrial, having a significant impact because of what's going on with the tariffs. But if you look at sectors like BFSI, they are looking at the stabilization of the whole economy, which will also impact how they're going to take decisions on discretionary spend. So what we have done as far as our guidance is concerned, we looked at all our clients pool across the markets that we do and across the sectors. Based on that, we have taken those inputs from the clients, and we are given the guidance of what you're talking about. And there is definitely uncertainty in the market. We are hoping, in the next few months, things would settle down and the clients will come back and restart the discretionary spend.
You spoke about how a large transformational project was paused by a client in Q4. That was one client. Were there many other instances where projects were put on hold, cancelled, or ramped down? Tell us more on that front, and how much did it impact growth in Q4?
Sure. So that was an anecdotal an example that I gave, because this particular client was right in the middle of what was going on the tariff. And what they did was they just paused, because they want to make sure that how the tariff will go, because that is a big input into the whole transformation program. So that's one example I'd given. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA. And majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
So do you think on the whole FY26 could be worse than FY25?
We don't guide for the year. So all I can say is you have seen our Q1 guidance. Obviously, it's minus 1.5 to minus 3.5. But having said that, I'm emphasizing this, that the deal pipeline is very strong. And if you look at last year, large deal wins have significantly improved for us. And we have a strong large deal engine that's working for us. And the pipeline we have, the focus right now for us in this quarter is to convert that pipeline into deal wins so that starting Q2, we can have the revenue momentum coming from those deals.
Aparna, your margin defense has been solid in the face of macro uncertainty. Can you tell us about the headwinds and tailwinds, what the margins faced in Q4, and what is the outlook on margins going ahead?
Yes, Rima, you're right. Our margin defense has been solid. In fact, we've improved margins year on year by 90 basis points or so. This has been possible because of strong execution excellence across, all parts of the organization, and it's been a one Wipro effort. We've seen fixed price programs improve their productivity. We've seen acquired entities improve their profitability. We've rationalized overheads. We've also rationalized staff who are non-client facing in some of the functions and roles in G&A. So all around, it's been a very solid performance in FY25. The rupee depreciation offset by the crosses also pitched in the second half. So it's been a good performance in FY25. As I look forward, the headwinds will remain a weak revenue environment. Added to that, like Srini mentioned, a lot of the pipeline and deals that we are in, clients are looking to take cost out. There is vendor consolidation. And as you know, these are very, very competitively fought deals. And they will have a pressure on margins as we look forward. What are the levers ahead? What are the tailwinds? Pretty much the same that we've driven through this year. I think we will have to accelerate, the benefits of AI in our fixed price programs, and we are actively, looking to do that.
So 17% plus margins, Aparna, you should be able to hold?
We don't guide for margins, Reenma, but that said, we have said our endeavor would be to hold it in a narrow band. So, 17% plus.
Okay, so you'll maintain margins in a narrow band, which is around 17%. You spoke about how these large deals are, competitively fought, especially when deals are harder to come by, given the uncertainty and the tough macro. Do you think there is some element of pricing pressure?
Oh, there is pricing pressure for sure. Is this any worse compared to how it was, let's say, a few quarters ago? I'm not sure. How do I contextualize it? But I do see that increasingly a lot of the large deals are vendor consolidation and cost takeout. So, yes, they're quite competitively fought, and therefore it does have pressure on margins. But that's where we'll have to work on how we deliver and how we can deliver more efficiently and how we can keep some of those productivity gains with us in order to improve, the profitability. So it's all about rate realizations as opposed to the rates that you're selling at. So we'll have to make sure we're able to deliver the same with lesser people.
Srini was just telling us how consumer, manufacturing, especially auto and industrials, are impacted the most. What percentage of your revenues would come from these impacted verticals?
We do call out the industry vertical mix. We call out consumer as an industry, and we also call out EMR. Collectively, so we don't really call out only manufacturing. We were reporting up until that. So collectively, there must be about, 30% of the business?
Saurabh, but TCS sort of surprised the street by saying that they're not doling out their wage hikes, which they normally do 1st of April. I mean, is the situation that bad that we have to hold back on wage hikes? I know yours are not due, anytime soon. But how are you thinking about wage hikes and hiring going ahead?
So 3-4 things, Rima. One is, as you rightly said, we did it in September, so we are far off. But the market remains uncertain. The macro environment is uncertain. We heard it from Srini and Aparna. From a hiring perspective, we have gone ahead and hired around 10,000 people from the campuses as we had called it out. We have a plan to onboard people, but we are also cognizant that we should not onboard and then not able to deploy. So we'll see how the market looks at market growth comes in the coming year. But we will have to just see it quarter by quarter is the only thing what I can say. So far, we have been able to make sure that all our people actions, promotions are happening every quarter. We did a salary increases ahead of time. We are giving variable pay. The full year variable pay is around 95% to a majority of our employees. So it's been a more consistent approach from an employee expectation and aspirations point of view, which has also helped us in managing our attrition. We also see that we have headspace from a utilization standpoint, which will help us deploy more people. So all this will drive hiring plans for the coming year, and we will closer to the time when we are there for our salary increases, maybe in sometime in Q2 is when we will have a better view on how the market is and what we intend doing.
All right, so that's Wipro's take on what lies ahead. We have to take a very quick break on that, and we'll come back on the other side and we'll get you the technical setup of the market today.
Okay, welcome back. There's about 15 minutes to go for the pre-open session, and we are going to be looking at how things start to trade. That Wipro conversation, of course, interesting. 40 points lower on the as far as the GIFT Nifty is concerned. Deepan, good morning. The big mover over the last 2 days has been IndusInd Bank. But the story essentially was that it got to about 0.65 times price to book. And now there is going to be, as we reported as well, source-based, but there's going to be a lot of change at the top. And some other senior management will be sort of phased out and new fresh blood will be brought in. What's your sense here, Deepan, IndusInd?
See, Prashant, we have seen many stressed out banks in the past, the likes of Bandhan and RBL. And, they were also hit by some controversy or the other, and then the stock price fell and there was change of management over there. But what I've noticed is that although IndusInd Bank is very attractive from a price to book basis, price earning multiple basis, what happens in situations like this when there is uncertainty around top management is the growth rates really suffer extensively. And you can have negative growth rates as we have seen in the IndusInd Bank releases as well. So from that point of view, I just want to just wait and watch as far as IndusInd Bank is concerned. And new CEO or new team when it takes over, it takes a while for them to really get the engine moving again. And at the same time, I think there are many attractive stocks in the banking space, in the NBFC space. I think I would prefer them over IndusInd Bank. But as a measure of disclosure, we are invested in IndusInd Bank and we remain invested because end of the day, the stock is quite attractive and it's a good brand. and a bank which has a very solid platform and distribution network as well. So I would just like to wait and watch maybe 6 months, 1 year down the line, IndusInd Bank may be an attractive investment opportunity.
Deepan, I wanted to ask you about NBCC. I recall a few years ago, I think you were quite positive on the prospects, and the street as well got very bullish, and then they didn't deliver. Now there appears again there is some interest in the stock. Any view on the stock? Yesterday it was up close to 7%, massive volumes, massive delivery at around 95 rupees odd.
Yeah, Nigel, I think we were positive on NBCC, but then the execution never really picked up and numbers never came through. But now I think we can see the company getting into a new growth phase, at least on the execution front. And end of the day, it's a bit of a reality play, I would say, because end of the day, the numbers clearly depend upon how many units, whether it's commercial or real estate or residential, which they're able to sell. But the real concerning factor in NBCC is the quality of the construction. And there have been a lot of complaints over there around that particular aspect. I hope the management has made some improvements over there. But from that perspective, I think long-term looks good. But I think a lot of it's got captured in the stock price. So existing investors may remain invested, but I'm not contemplating a fresh investment.
Okay, one more stock, Z Entertainment, one of the rank underperformers. But at times you say, at this price, something looks okay. And the promoter entity came in there, they bought some, 0.2, 0.3%, I think, just before the end of the quarter, before they go into the cooling period. They have guided for better times in the coming year, with regard to margin improvement. And some argue that valuation-wise, at around 100 rupees, it's okay. It's around 113 rupees. Yesterday, there was another stock that popped up. Interested or just stay away?
No, I think you can keep it on your radar and see if there are actual perceptible improvements in the performance, the margins, and especially Z5, how that is shaping up. But look, it's an industry where there is intense competition and still disruption is underway. Habits are changing. Advertising revenues are under stress. Subscription revenues are under stress. They are facing a lot of pressure even in the global markets, overseas markets as well. So, I mean, I keep it on my watch list, but just because it is cheap, I'm not running in, and investors shouldn't run in to buy the stock.
Got that. We'll take a quick commercial break here, Deepan. Stay with us. A couple of pharma names I wanted to check with you as well. Zydus, for example, fell sharply. Lupin was down as well. We'll also get you technical ideas. Mitesh and Sudarshan waiting on the other side. Stay tuned.
Welcome back. So cues across Asia have been fairly solid. In fact, even now, most of the markets are retaining gains of 1%, some even more. The Hang Seng is up about 1.1% at this point in time. Let's pull up the implied open and see what it's pointing to. Now it's reduced that to drop to about 39.40 points. So let's see. We've got our technical experts joining in to talk about some trading ideas for the day. Gentlemen, good morning. Great to see you in, Sudarshan and Mitesh. So the question is, which way could we go? Because it's a little confusing today. Wall Street was down, Asia is up, implied open is suggesting 40 points lower. So Sudarshan, what would your advice be for the day? Morning.
Yeah, good morning. See, my advice would be to stay with the trend, which is up. The short-term trend is up, and we should be looking to buy on dips. Yesterday, we got those dips, and I think today, the morning open itself would represent a small dip where buying is suggested. The problem is something else. The problem is that we have now an extended weekend, and Monday would be a holiday in most Western countries. So the question then is, do you want to carry positions? And I don't have an answer to that, but for today, I would be a buyer.
Okay. Mitesh, what about you? What would your approach be for the day?
Surabhi, I think, good morning. One, we have maintained that the markets are positively biased and we have already cleared 23,400, which was our first target. Now look at revised targets of 23,600 and then possibly 23,750 to 800 zone, which is a very important and has cluster of supply pivots. So I think that's the target which we are heading towards. In that sense, I think stay positive. A lot of sectoral indices like the Bank Nifty, the Nifty Energy Index, etc., are looking positive. And the stock chart patterns are also on the positive side. So in that kind of an outlook, I think it's clear that the idea should be trading long bias. I've already given the targets on the Nifty. On the Bank Nifty, I think the earlier weekly highs, which is the all-time highs, that zone of 53,650, 53,800 is what I'm looking at.
Gentlemen, morning. Mitesh, what would your trades be?
Yeah. Morning, Prashant. I have a buy on Bandhan Bank on a mild decline, say around 157, 156, buy with a stop at 153 for a target of 165. Adani Ports is a conditional buy. The pattern is very good, but with the gap down opening, you might get a slightly, a negative kind of a movement in the first few minutes. So once it crosses 1235, 1236, buy with a stop at 1219 for a first target of 1275. Similar kind of call on Prestige Estate, which is a buy about 1220 levels with a stop at 1199. Look for targets of 1265, and BHEL Bail is a buy with a stop at 220 for a target of 230.
Got it. Okay. All right. Sudarshan, what about you? What are the stock picks you have?
Yeah, I'll quickly amend my index calls. This is a festival and it's very unlikely that we will see adverse news during a festival. So traders could actually carry long positions using call options. Now my calls are also on the long side. ABB is a buy with a stop under 52.68. Alchem, another buying opportunity, stop under 48.51. Canfin Home from the NBFC is a buy, and I'm repeating, the NBFCs are likely to outperform. So Canfin Home is a buy with a stop under 678. And finally, Oil India is a buy, the stop under 370. Stay on the long side.
Stay on the long side. No, absolutely. Point taken. By the way, on Indocent, is there a view, Mitesh, do you have a view price-wise?
This is a stock which reversed after that big decline and is heading towards a gap area, which is, when the news broke out and the stock opened with a negative gap, which is in the range of about 812 to about 870. I think anywhere between 820, 840, you'll see the stock facing massive supply. So if people have bought at lower levels, I think this is the area I would want to take profits.
Got that. Thank you very much, both of you, Mitesh and Sudarshan, with perspective on those names. Deepan, I was earlier talking about the pharma names, Zydus, which fell sharply, about 7%. There was Lupin. Both companies launched this at-risk drug, which the courts ruled, the ruling is adverse. And this was substantial, about some $25 to $35 million in quarterly revenues is what was expected. Any thoughts? What's your take overall on this space?
See, Prashant, I think these are the risks which are always there in investing in pharma companies, and that along with US FDA inspections does cause a lot of volatility in the stock, but then eventually they overcome it as well because underlying trends of the industry are positive, and at least until these Trump tariffs, we were seeing secular improvement in pricing and a lot of new molecules also going off patent, providing opportunities to these companies, and globally also they were expanding their footprint. But this Trump tariffs have put a question mark on the prospects of the pharma industry, and how much is the tariff on what type of drugs it will come, very difficult to say. But it's a big industry, and I think that the best place in the pharma industry to be in would be the CDMO players, the likes of, say, Divi's Laboratories, Suven, Blue Jet, these companies, maybe even a Syngene, one source. I think that's where we are focusing our research in the pharma industry. And that's one segment within the pharma industry which may not get that impacted by Trump tariffs as well, given the nature of the business model. And they really benefit from the kind of tariffs which are there on China and other such regulations which are underway in the US as well. So very positive on the CDMO space. They're very expensive, but the results will surprise us on the upside.
Okay, all right. Deepan, I wanted to ask you about these EMS players. Companies like Dixon, they're up close to around 15% or thereabouts. And over the weekend, these companies were in focus because US, they import roughly around $250 million of, smartphones, computing devices as well. And out of that, China accounts for close to around 30%, while India accounts for only 5%. So there was that hope that some of these EMS players, they have a bigger opportunity. What's your view on some of these EMS stocks and which one do you prefer?
See, Nigel, the likes of Dixon are really very expensive, although surprisingly the growth also is very strong, no doubt about it. But, buying a stock for 100p plus always is a bit of a risk factor over there. Other EMS manufacturers, I think gradually the valuations are getting more in the zone where it is comfortable. I particularly liked the numbers which came through from Syrma SGS for the September quarter. Good earning visibility, September and December quarter. Good earning visibility. I think March quarter also be pretty decent. And valuations which were extremely rich at some point of time now, because earnings have caught up and stock has corrected, are in that reasonable zone. So I would say that from a fresh investment perspective, that looks interesting. But existing investors in EMS companies should remain invested because end of the day, the growth is fabulous. Just because the stock is expensive, I wouldn't look at exiting it.
Deepan, just two other names. We spoke about Indocent, of course. There are deals brewing in two other specific names. One is, we'll probably get the announcement soon, IDFC First Bank. I don't know if you have any thoughts specifically on that name. The other one, as Nimesh has been telling us, and now, of course, there's an exchange notice as well, 360 ONE, which is the wealth management business, where, what we understand is there could be a strategic player who comes in, takes a position. Any thoughts here, Deepan?
First, a disclosure, we are invested in both these companies and very positive on the prospects of IDFC First as well as 360. And especially wealth managers, I think, have a very great future. And you should intend to hold these companies for 5, 7, 10 years or so. And these companies can really turn out to be great outperformers, considering the kind of dynamics which are under play over here and the opportunity available for such companies. Also very positive on IDFC First Bank, amongst the top 2-3 fastest growing banks, pretty well managed as well. But for some reason or the other, it has underperformed, at least our expectation. But now that the climate has improved for the banks, the overall industry trends have improved, I think IDFC First should start to deliver very good returns going forward. So positive on both these companies, but as I said, we are invested in them, so our views could be a bit biased on the positive side.
Point taken. Right on cue, Deepan, stay with us. That news has come. Board has approved fundraise of up to 7,500 crores from two separate investors. That's a very large fundraise from IDFC First Bank. News hitting the exchanges, and we have the sort of details at the bottom of the screen. And we'll put out more in terms of who the two players are, the two investors are who are coming into IDFC First and putting this money in. In the pre-open, stock's high, but I think it should start to react. This is still very early days, within the first minute or so at this point. So more details in a bit from now. There are the two investors are Currency and Platinum, I think. Yeah. We'll have details. We'll put those names up as well in just a bit from now. These are CCPs. To these two investors, which are which is happening now. Lata is joining in with just a sort of take on the fundraise and what this would mean for IDFC First. Lata.
I'll just give you a few more details from the press release itself. The CCP's PS are done at around 60 rupees or thereabouts. To both these two, we have Currency Investments. That they are taking a larger chunk in comparison to Platinum. So that's another data point that's come out there. And at current prices, if I just try to pull it out, it's a dilution of roughly around 13% or thereabouts, just prima facie looking at that, going by the current market capitalization or thereabouts. So Lata, that's just a couple of details I want to give. The pricing of the CCPS, which is at around 60 rupees or thereabouts.
Yeah, so that's very much at the market price that they are coming in. The gain is coming now after the news is hit. So it's pretty much maybe a slight discount to yesterday's closing market price that it has come. Actually, it was well capitalized. If I remember right, at the end of their the third quarter results, they were over 16% in terms of capital adequacy. So this is clearly a lot of capital that's coming in, but then it's almost a 25% growing bank. So they will be able to absorb this capital perhaps in a couple of, maybe in 3-4 years. At the moment, it will be a bit dilutive. But, for all companies, you get capital when capital is available. When you look like you are in need of capital, you don't usually get it. So I think it's a wise thing. And foreign investors coming in, I looked up their shareholding pattern at the end of the March quarter. I think it was 25% foreign investors. So now I think that goes up sizably with 2 separate foreign investors coming in. Currency is one of them, and
25% is the FI holding. That's correct, as of March.
As of March, yeah. When they last reported, it was 25%. So now this goes up. We have to see how much is the dilution. You said 13%.
Yeah, approximately 13%.
Okay, so that would mean that it's at least 35% that you're going to see in terms of...
Current market cap is 46,000 crores or thereabouts, so 7,500 crores.
So, yeah, it's almost about 10% addition, or no, a little more than that. Yes. Nearly 20% addition to the capital. 15%.
I think we have Deepan with us as well, so let's just toss it to him. Deepan, you heard, we were just talking about it, because you own IDFC First in your portfolio as well. Some of the details coming through, any thoughts?
I think I agree with Lata that you raise capital when you can, and certainly it will improve the growth rates at IDFC First Bank. But look, when we're evaluating banks, no, we are not really looking at the growth rates, but more how they are managing their NPAs. And the banks which have the lowest NPAs and the lowest surprises when it comes to NPAs are the ones which are rewarded by investors. But nonetheless, I think, IDFC First Bank is reasonably valued and has a good growth prospect going ahead. They are gaining market share. And what I like best about IDFC First is you compare it with its peer group, its CASA ratio is very impressive.
No two ways about it, Deepan. It is a well-run bank. What I really like about them is that they concentrate on deposit growth. It's one of those banks, for a small bank, it's not very easy to raise deposits, but the accent is correct. If I remember the Q3 results right, the accent on deposit growth is to be appreciated. As well, they had stressed assets only in their MFI sector. It didn't spread to their unsecured retail portfolio, which also is a positive. Deepan, would you really worry about the asset quality? I thought, anyway, we will get to know only by end of today, I think. Results are today, right? I think the results today or tomorrow. The results are like round the corner. But is the expectation, do you have any fears of asset quality at all?
No, but you have to keep an eye out for asset quality on all of these companies, So I don't think it's so much of a concern. And the overall cycle also seems to be improving in the sense that the base effect will start turning favorable when it comes to NPA provisioning, because last few quarters we have seen 50, 60, 100% jump in NPAs. I don't think that will happen going forward. And then the core profitability, the core operating profit margins, a lot of it will percolate to the bottom line. So that's going to be the theme for all the banks in the March quarter, according to me.
Got that. So we'll come back to the IDFC First Bank story, and hopefully Mr. Vaidyanathan, the top boss at IDFC First, also will be joining us, and Lata will be with us here for that as well. So that's in a bit from now. Stock's absolutely flat with about 6 minutes of pre-open in. Well, the other big company today in focus will be Infy, because that will report numbers after markets close. Let's get a quick preview going with Rima, what the street is expecting. Rima.
Well, after both TCS and Wipro have disappointed the street, now for Infosys, the only question is, will they guide or not? Because Infy's guidance is typically an annual guidance. You don't know in the second half of the year if the macro situation deteriorates or it starts improving, discretionary spends come back, and that changes the entire picture. So it's very hard to, we spoke to the management of TCS and Wipro, and it's almost impossible to gauge how this year is going to be. Wipro had visibility only perhaps for 3 quarters, because we even asked them about how FY26 is going to be versus FY25, and there are no answers as of now. So the question is, will Infi guide or will they not? If they do guide, some of the estimates on the street are 2 to 4%, 1 to 4% is by Kotak and Ambit. But again, these estimates were set in towards the end of March or in the early part of April. And since then, it appears that things have gotten a little more uncertain. So maybe the management, if they choose to guide, could be a lot more conservative. In terms of Q4 numbers, there's less attention paid on them. But for Infosys, dollar revenue growth is seen down 1.4%. Constant currency revenue growth seen down 1.1%. Margins could come under a bit of pressure because of wage hikes. Back to you.
All right, Rima, thank you very much for that. So all eyes on Infosys.
I'm telling you, this guidance business, they should take a leaf out of United Airlines. I just pulled that up. You know what they said? A single consensus no longer exists, and therefore the company's expectations have become bimodal.
Bimodal.
Bimodal. So there is this and there is that. So
Two
we don't
different
know.
scenarios. Yeah, but I mean, by the way, what Wipro has said that the next quarter, Q1, revenue is going to fall from 1.5% to about 3.5%. That's the extent of so-called degrowth that they're talking about. Stocks taking it on the chin, 5% down. Margins are fine, but still, when you have the company coming out and stating that transformational deals are getting stalled, that discretionary spends are under pressure. And even on margins, they're saying that there is vendor consolidation going on. So even there is a fight on pricing, but they're trying to optimize internally and keep the margin at around 17% at least. Wipro taking a bit hit this morning.
And Wipro is the one that from the frontline index is down close to 5%. Pull up the chart of Sonata Software. That one's down close to 9% as we speak, because they are saying that they're one of their large clients out there. They're facing some trouble, and that's why in Q4 itself there'll be some kind of pullback in terms of their numbers. So that's why that stock, it's down close to around 10% or thereabouts. Just wanted to point that out.
Absolutely. Actually, I was looking at some of the others as well. Look at LTI Mindtree, 3% lower. In general, get ready for a bit of a rocky ride on IT for sure. Let's see if banks can offer the right offset. Which brings us to the 9-10 calls as well. We've got Sudarshan joining in. Sudarshan, your 9-10 call, and also just a word on Wipro for those who have the stock. Any levels to watch?
Well, Wipro is a complete avoid for those who don't have it. If you have it, then you have to stick with it. There are no levels because you might end up getting out at the lowest. So just stay there. Canfin Home is a buy with a stop under 678.
Okay, and I think we have Mitesh as well. Mitesh, your 9-10 call?
I'll go with the buy on BHEL for targets of 238.
Okay, all right. BHEL. Gentlemen, thank you very much. We'll speak again soon. Just to sort of quickly go back to the IDFC First story, Nimish is joining us as well. Nimish had told us first, as part of his chatter, that something is coming. Well, something has come, and it's not something, it's pretty big. Nimish, you want to add inputs?
So, Prashant, now there is an official confirmation from IDFC First Bank. So, two large investors are putting money into IDFC First Bank, close to 7,500 crores. One entity is part of Warburg Pincus, and the other entity is part of Abu Dhabi Investment Trust, which is ADIA. So, two large investors putting in money. It's a compulsory convertible instrument is through which they are putting money. So, it's at 60 rupees per share, whatever I could read in the press release. But the important part is the bank is raising 7,500 crores from two of the largest investors, Warburg Pincus and ADIA. As far as Warburg Pincus is concerned, Prashant, Warburg Pincus has been associated with Vaidyanathan and IDFC for a very long time. First, they invested in Capital First. Last year, interestingly, they sold completely out of IDFC First Bank, making some 8 to 9 times return on their investments. And now they are re-entering into IDFC First Bank, putting money via convertible. So, important deal for IDFC First Bank, 7,500 crores raised, and from two large market investors.
All right.
Yeah, actually, that's an important point. Warburg Pincus in the earlier avatar of IDFC First Bank, Capital First, they had 25% stake or something. Yeah. And they exited completely from IDFC First Bank exactly in March 2024. Yeah. So a year ago, and now coming back in another avatar.
into the bank. Absolutely. Nimesh, congratulations. Thank you very much for that. Let's talk about the other big stock mover for now. Sonata Software, right? We were just talking about that. Rima is here with what she's picking up. Rima.
Thanks so much for that. So Sonata Software has issued a revenue warning. They've informed the exchanges that the revenue that they were expecting from their largest client is going to be a lot lower than what they were earlier anticipating. And therefore, there will be lower revenue from the international business. You know, one of the analysts who looks at Sonata Software very closely indicated that earlier they were anticipating about a 3% revenue decline in Q4. But now the revenue decline could be high single digits. So we are looking at a big miss for Sonata in terms of the top line. The stock has been under pressure with a fall of about 44% already. Back to you.
Rima, thank you very much for that. Stock's down about 10-11% now. 3 minutes to go for market open. Maybe, you know, the IDFC First flashes, we can change the names to Warburg and Adia. If it is technically correct, we can maybe just check and put the names up. I think we are doing that.
Yeah, we had the alert on the screen.
alerts out as well. So, you know, much more identifiable kind of names and in that sense, helpful. So,
GIC also had, when Warburg sold, if I remember right, I think GIC was also one. So it looks like all sovereign wealth funds seem to prefer
coming in, absolutely. Well, I think 2 minutes to market open. Tahir Badshah is our market master, Chief Investment Officer at Invesco Mutual Fund. Tahir, good to have you with us here. Good morning, appreciate it. You know, one of the first big market to come back to 1st April levels, which is the so-called reciprocal tariff levels. So it just tells you, right, the market wants to go higher, lacking triggers maybe for now. What's your sense?
Yeah, I think it's nice to have seen a recovery, and you know, it was from obviously somewhat very beaten down levels, but then we've covered some distance as well. So you know, it's hard to probably call a very strong market direction at this stage, one way or the other. I think we probably just float around at these levels. In my view, I think some of the issues will probably take a little bit of while to pan out, though I would like to still believe that the bulk of the damage on the first round of headline tariffs at least is behind us. We obviously now move to the negotiation table, and you know, we'll see how it goes with different nations. But to me, it looks like you know, the first round of the trade conflict or the trade war is probably been against the US in various ways, and evident from the fact that they've had to backpedal in many of the areas. So I think we'll have to see as to how it goes. Do they back down a little more, or is it going to be a more aggressive posturing going forward from here, from their side? Meanwhile, I think this 90-day deadline also is not something which is very feasible. But I would still, from their point of view, I think they will want to push it as early as possible so that they can get going with regard to the benefits that they want to derive. So point being that, look, I think we are at a stage where, you know, we have to bank as of now on our domestic levers.
Absolutely, and that is what we will focus on, Tahir. Sorry, apologies, just interrupting markets opening. Just coming back and we'll finish that point. Nifty 50, 23,390. We're down about 1/3%. Bank Nifty is flat. I mean, this is just sort of, you know, neither here nor there. Nothing on the Nifty Bank for now. The mid-cap index is down about 0.3, and I think you've got the small-cap index, which will come up on as well. And there is about 0.25% cut on the Nifty small-cap index. Market breadth for now is positive, but this is just, I mean, the initial first minute or so that we have. So it's a slightly subdued kind of start. But, well, we all know what happened yesterday, right? I'm not saying, well, the same thing happens, but yesterday also till about 150, things were very subdued, and then things took off like a rocket. But, I mean, as we go into today's session, remember, we got a 3-day holiday in front of us. That Nifty heat map, more down than up. You got about 13, 14 names which are higher, everything else starting lower. Surabhi.
Okay, so on the lower side, of course, is IT. No surprises there. Wipro's down 5%. HCL Tech 2%, Infosys ahead of numbers 1.6% lower, TCS is selling off about 1.5%, Tech Mahindra, all those stocks are down. The other problem for the market is that consumer stocks aren't really finding much mojo this morning. Asian Paints, Nestle, Titan, most of them are on the lower side of the screen. Then come your heavyweights. L&T is not really contributing much. In fact, it's down 1.2%, Reliance 0.5% lower, ITC is down about 0.3%. Lever, like I said, along with the rest of the FMCG pack, also weak. The only part that's working for the market are financials. ICICI Bank 1.4%, HDFC Bank 0.4%. And that's about it. Even financials very, very selective for the time being. There's some buying on pharma this morning, which is interesting. Dr. Reddy's is up and about, Apollo Hospital, Sun Pharma, Cipla. Pharma is doing okay, and top financials are doing fine. Shriram Finance also about 0.7% on the higher side. So it's pharma and banks, to the rescue, but IT is in a trouble spot.
Well, that's right. Surbhi, a couple of stocks, though, that are in focus. Angel One, the stock is down closer on 4.5% because of those weak numbers. On the flip side, you have the Vare Group companies. I think Vare Renewables came out with its set of numbers, and that stock is higher. Vare Energies as well is one of the top movers on the upside in today's trading session. So both those two should come up for you. Big green is what we're seeing on both those two stocks. The other banking name that's doing well is Ujjivan Small Finance Bank. Well, that's up by closer on 5%. It's moving on very, very large volumes. I think you should get that one up for you on the screen. IDFC First Bank is now at the low point of the day. I'll tell you what, in the last 1 month, the Nifty Bank is up closer on 9-10% or thereabouts. It's done well. But IDFC First Bank was up 15%. So it appears there is some profit taking that's coming on this counter. And that explains why that stock, in fact, is actually down closer on 3%. It's seeing some kind of profit taking post the recent big run that we saw. Tanla, well, that was one as well, had some positive news flow. So that stock, in fact, has opened up with some green on the screen. JTL, well, yesterday the stock got slammed back because some reports indicated that there was an ED raid. But for the time being, the stock has pulled back closer around 5% or thereabouts. You need to understand whether or not it's on the investor with regard to that betting scam, or was it on the company? So I think the street is still waiting for a response in the management. For the time being, the stock is up closer on 5% after getting slammed 18% in yesterday's trade. Vare Energies, though, that's the stock of the morning, up 6% as we speak.
Yeah, no, absolutely. 23.66 on Vare, and that is a big mover. And by the way, Vare is now the number 2 biggest volume-led gainer on the NSE. Number 1 is Mazgaon Dock. Mazgaon is up 3%, but I mean, outsized volumes on Mazgaon for this point in the day. I mean, just about starting. 500,000 shares already on Mazgaon. And, there is Vare Energy and Vare in the other Vare company as well, which is up 12%, 1151 that's the one, renewable.
That's the one that came out with its numbers.
Yeah, that's the 12, which is up 12.5% right now. So big one, and both have got tremendous volumes at this point. K Fintech is up 3%, 1,084 on K Fintech. Again, very large volumes. Garden Reach 2% higher. Again, another one more shipbuilder, along with Mazgaon, which is showing up with gains. You got Amber, which is up about 2%. KEI Industries is up about 2.5%. Cochin Shipyard. So you got all 3 shipbuilders now, which are up strongly. Yesterday, you had some moves in these hospital names. On the downside, I can spot Narayana on the upside today, 1.5% on this one. We were talking about the Vare sort of twins, but also look at Weber Solar, which is up 5%. Premier Energy, again, in that space, 2.5%. So, yeah, I mean, there are shipbuilders, there are these solar names, both which are kind of sort of moving up as a pack. Wipro is now, by the way, the biggest volume-led loser. It's down 5.5%. Stocks at about 234. It's followed with Infi, the preview for which we just put out with Rima 5 minutes back. Numbers after market hours. And I think certainly with what Wipro has done, expectations from, the consensus expectations, etc., the general hope from it would perhaps be a little lower. Angel, of course, we highlighted numbers, 4% lower. IDFC First Bank is down 2%, 62, and has got tremendous volumes in it as well. TCS is down 1.5%. Sonata Software, LT, I think IT on the downside is emerging as the sector. So maybe the IT index will come up. Yeah, 2% lower on the Nifty IT index after yesterday's near 1% cut. So 32,591 on the Nifty IT index. Tahir Bacha is with us. Tahir, I interrupted you there. You were talking about, of course, the global uncertainty and the wait and watch, but the local drivers here. I mean, rates is one, right, on the downside?
Yeah, I think rates obviously will be headed lower. Earlier, the expectations were for probably about 50 to 75. We are probably now looking at more like 75 to 100 over the course of the next 9 months or so. So I think that part is quite certain. We have some of the other drivers as well, in the sense that, liquidity is up, regulations are somewhat loosening, government policy and actions are probably a little more vibrant compared to what they were in the prior 2 quarters. So I think there is obviously the one straw that we can probably hold on to at this stage is the fact that we can probably see improved domestic growth. However, upcoming quarterly results, etc., will probably not reflect that. It will therefore require a certain amount of patience from investors to see some of these, actions which have been taken to translate into growth over the next couple of quarters or so. So I think that's basically the name of the game at this stage.
Tahir, hi, great to have you on the show this morning. So the question is what you said, that the market might not skyrocket from here, but it will continue to bounce around. Earlier, every time there was a dip, there was a template. You just have to go by and back the same leaders, the same PSUs, the same capex stocks, the same EMS companies. Has that template broken, or has it been challenged? And what are you doing with the earlier leaders, the old favorites now?
So I think at least some of those that you called out are still relatively more domestic oriented, and probably even from a tariff perspective on the right side of things. So I would like to believe that they will still remain the go-to kind of areas. And even for us, I mean, beyond a particular point, if we have to identify places in the market which can grow ahead of system rate of growth, I think only some of these, whether it be industrial, some parts of consumer discretionary, parts of real estate, etc., are the ones which we can probably go to at this stage. So I think that continues even at our end. There have been a couple of other parts which have joined the fray, I would say, in some manner. Let's say value consumption at one level seems to be making some sort of a comeback, and rightfully so after a long cyclical downturn. And I think we have seen some initial reports on the monsoon, etc., which probably are also promising. So let's see how that pans out. These are all things which are up to see as to what how they turn out to be. But I think these are the areas where probably there is some value. I think pharma too is another area. Combination of some domestic pharma as well as some of those which are probably going to be somewhat better placed, even with a tariff scenario coming into play. So pharma healthcare is another area where we can probably, bank on somewhat better earnings outcomes compared to a few of the other pockets of the market.
Okay, all right, that gives us some ideas. By the way, just want to draw attention to the market once again, because now things have taken a bit of a deeper knock. It's a 120-point fall now on the Nifty. And the problem for the market is that barring one or two of your large cap financials, banks or non-banks, nothing else really seems to be working today. There's a little bit of pharma, but then the tech fall is really deep. Wipro is down now 6%. It's taken the whole sector down with it. FMCG is not working, and even stocks like L&T, Reliance, the other big boys, not able to help the bulls case, at least not right now.
Well, that's right. There's only so much that the Nifty bank can do. The Nifty IT index is under the weather. The Nasdaq was under pressure overnight. You had those numbers from Wipro. And there is a bleak expectation coming in for Infosys. So all those three factors, they are weighing on the IT index, though the Nifty bank is still holding with some mild green out there. And if we need to fight back today, the Nifty bank will need to lead the way. Tahir, good morning. Good to see you in. What's your take on these IT names? One argument is that, in fact, valuation-wise, they're pretty okay. They've come to the long-term averages. The problem is there's so much of uncertainty. Guidance cuts, weak numbers. And, you don't know what Mr. Trump is going to do next. What's your approach to these names?
I couldn't agree more, Nigel. And, I have also been kind of latching on to this view that tech will probably be, to some extent, a reasonably good defensive and probably, help us ride a little bit of the domestic volatility. But, of course, after these developments, this is the most headwinded sector that we can probably think of at this stage. Both in areas of growth, obviously, we are probably going to find it difficult from everything from whether it is tariffs, slowdown in the US, what happens to Doge, and consumer spending and consumer discretionary as far as the US is concerned. So I think there is a fair bit of challenges which are around. And I think at this stage, the only argument that probably is can be made to work for the IT companies is their valuations, and not necessarily as much in terms of price to earnings multiples, but probably if you look at them from a free cash flow yield or an earnings yield perspective, or an cash flow yield perspective. So I think that is the only thing that you can probably latch on to at this stage. But then that clearly means that these now have turned into, they can only be seen as from the lens of value, and then you have to be a patient investor in order to probably get your returns over a period of time. So this, to my mind, is a sector where today, in my mind, is also a debate of whether we should even be a neutral. We should even be holding a neutral weight as far as the sector is concerned, but that's where we are.
The cash flow yield, you said, Tahir, was what, around 5-6%?
I'm sorry, what is that?
What is the cash flow yield for these companies right now?
So we are at the lower end of the band, more in the vicinity of 4.5, which is not bad. But that is the only hook that you can probably, as of now, latch on to. But obviously, both news flow wise, numbers wise, we're seeing that in some of the results which have come by, it's not going to be an easy ride. Then we also have the obvious overhang of what happens to AI, at least in the short run, if not in the long run.
Okay, so that's IT and it's clearly under the weather, like Nigel said. Pharma, something that you said perhaps offers a little more opportunity. Just expand on that point, Tahir, because I mean a lot of these companies also have significant US exposure. We don't know if they'll be off the hook or not. There's still some uncertainty there.
Yeah, so at least some parts of the pharma system, pharma sector, which probably is not necessarily only generic based, even if it is exposed to the US, is probably going to be able to weather it better. So upcoming spaces for mid-sized companies, CDMO, CRDMO, that is the part which probably will hold up a lot better, because that is something which at least where there are companies which are relatively better positioned and probably can, are in a position to demonstrate growth which is in the vicinities of the 20s over the next 2-3 years. So I think that space holds, to my mind, a relatively better, attractiveness. And I think then we can always, we also have the option of supplementing that with some of the domestic pharma stories, plus some of the healthcare options also that we have. So that at least makes it as a good combined, parcel, which probably can occupy some decent overweight in the portfolios.
Tahir, just one point as we are winding up. I mean, this point on earnings and narratives shift with stock prices. I've always seen that in my stock market reporting career. When we started the year and Q1, Q2 were bad, we said, oh, it's because of elections and government is not spending. Second half is going to be very strong. It'll be a big recovery. Then we came to Q3. Q3 was a complete washout, 5%, 6% earnings growth. Now we're at Q4. I mean, do you see more downgrades ahead? What is your assessment, expectation from Q4? And more importantly, as we step into the new year, what lies ahead in terms of corporate earnings growth?
So if I were to go back, my memory serves me right, I think we saw the worst, from a market standpoint and from a shock and awe perspective was more like the September quarter, the second quarter of this fiscal, which was clearly subpar, significantly subpar and well below, early single digits. And that's something which probably was the biggest shocker. But I think after that, the expectations then have obviously moved down. There have been earnings cuts along the way. And now I think the market expectations are relatively more, I would like to think at least for the near term over the next 1 or 2 quarters, relatively more subdued. Having said that, I don't think the March quarter results also will probably be able to significantly surprise. I only am hopeful that the pace of earnings downgrades from here on probably will abate compared to the last 2-3 quarters. We are somewhat away from an upturn in that cycle, in the sense that we'll probably take some time before we get into an upgrade cycle. But I think the market will take comfort if there are no further downgrades. And that is what probably March quarter seems to be looking like. Look, like as I said, I mean, we are even while some of those domestic drivers are clearly starting to shape up, but by the time they reflect into numbers, will be a few quarters from now.
It'll be a few quarters from now, but maybe, I mean, Q4 will be weak. Overall, I don't think too many expectations. But of course, the market's not pricing in what Q4 is going to be. It's trying to gauge what, where things will be 3, 6, 1 year down the line. And there, as Tahir says, maybe things are looking a little better. Maybe, just to take a quick look at what's happening around in the market, broader markets, apart from what we've already mentioned. IT, of course, I mean, the index is down 2, that's a big one. Hero MotoCorp is down 3%, 36.77 on Hero. So that's coming up with a large cut. And what else? I mean, Tata Elxsi and JSW Steel, Titan, Coal India, these are all down between 2-3%. There's Naukri, that is Info Edge, which is down about 3%, but that's again like an IT name. Chola Finance is down about 3%. AG's Logistics, but it means sharp move up in the last 2 days. That is coming under some amount of pressure as well. Godrej Consumer Products is down about 1.5%. So that's the overall picture. 100 points lower on the Nifty is what
Prashant,
you have.
we have our guest with us.
Yeah.
The man of the moment, V. Vaidyanathan, the managing director of IDFC First Bank, has joined us. Mr. Vaidyanathan, many congratulations. I believe you've got two big marquee investors picking up stakes in IDFC. Can you just first take us through the numbers? What does it mean in terms of capital coming in? What does it take your capital adequacy to?
First of all, thank you very much, Lata. Yes, it's a really, really big deal and a very, very important day for the bank because we get 7,500 crores of equity capital. And it's coming in the name of Platinum Invicta, Current C, which is an affiliate of Warburg Pincus. They're getting 4,900 crores approximately. And Platinum Invictus, which is a subsidiary of ADIA Private Equity Division. But ADIA is a really big name, the private equity division. So both are iconic.
No, both are big names.
Big name, like iconic. And, you know, we have worked with Warburg Pincus for like 12 years now. They're really like wonderful, wonderful people. I'm really...
Actually, that was going to be my question to you. I remember it was in March 2024 that they sold off their stake at a very high gain. But what made them come back in just 1 year and 1 week? They've come back to you. What was their thinking? Did they tell you?
Honest answer is I chased them.
Okay.
I chased them because I think the bank needed capital. So I messaged them. I reached them directly. I told them, please, I'll be really happy if you came in. And of course, when we pitched the story, we told them how the bank is set for a phase 2 of growth, how we can create really phenomenal value in the next maybe 5, 6, 7 years. And they are long-term investors. They can see that they made a lot of money last time. Okay. So they felt excited to come again.
Yeah, it looks like they made some 8 or 9x, if I remember right, in terms of where they came and when they exited. But Mr. Vaidyanathan, you see, you needed the capital you don't really need. At the moment, you have a surfeit of capital with this 7,500 coming in, right? What is your capital adequacy now and what was it before?
Like 16.4 or 5 right now, and it'll go to 18 point, close to like 19% after this raise. The thing is, Lata, that, as the CEO, I have 2 very big responsibilities to run a super safe bank. Super safe bank. Super safe bank is how diversified deposits are, etc., and how quality of loan book is good. All that is super safe. But capital is a very, very important part. I take that as a responsibility. And even though we were 16 plus, I have to be honest, I wanted to raise more capital. And capital positions us for growth because you see, one of the key things is profitability. Yes. So the next phase of growth will give us operating leverage, will give us profitability. So I'm really keen about that.
Okay, but it would also mean immediately dilutive of several ratios, right? I mean, at the moment, the stock is showing a red tick probably because of that. Of course, the market itself is in the red. And your share, I think, ran up a decent amount in the last 1 month, about 15% or something. You saw a good gain. So maybe a bit of sell-on news is also coming in. But it will be dilutive immediately when you have, 18, 19% capital adequacy.
Yes, this will have a dilution of 15%. But really, Lata, I want to just share one thing to you and to all investors hearing this program, that the main thing is that the bank has a phenomenal model. Otherwise, our operating profit could not have grown from 750 crores to 6,000 crores in 6 years. It's not possible. So we have a really good model. But my one big learning of life, one day I saw an interview of Jeff Bezos, about Amazon. He talked about, he said, I have a wonderful product, wonderful molecule, but without capital, there'll be no Amazon. It's like that. Today, we have a phenomenal product. People are not seeing the full power of it yet because of, liabilities, loss, and credit card loss, etc. If you take that aside, bank is very powerful, economics, but capital. So if you have capital, this can grow for a long, long time. I really believe that the next phase of growth is transformative for the bank. Bank will be very profitable in the future, and I think you will watch it happen.
Okay. No, I mean, if capital was important for Amazon, it is much more so for a bank. I take your point on that. But how much can you share now? I know you're in a pre-result silent period otherwise, but can you share what do you want to use this money for? Is it earmarked for branch openings? What is it for? It's
the growth. There are 2 things, actually. I'll keep it very simple for you. if you see the loan book of the growth of the bank, just the retail component of it, retail, MSME, agri, that SME kind of stuff, that was 100 crores in 2010. Today it is 2 lakh crores. So it should give you no surprise to guess what this will be, let me say, 5 years from now. It should go one way up. I'm very clear about that. So that growth, let me call it like at least 20% CAGR for 4 or 5 years, at least that much I can see. So for that is one thing to look forward to in the longer sense. And number 2, utilization. So basic answer is growth. Let me tell you, the bank has for 5 years not posted a loss. No intention of posting loss in any quarter, any year, any time now. I can tell you that much. So it's all growth. But second important reason is that there are some businesses which are also, at a stage where it needs scale up for profitability. And there are 2 such businesses.
Okay. You have a lot of sovereign funds. I mean, if I remember right, you had GIC also as one of your shareholders, and now there's ADIA. Can you tell us about the kind of shareholders you have? And also, what does your foreign holding now go to? When you announced your numbers after March, it was, I think, 25%. What does the foreign ownership now go to?
Okay, I don't have the number offhand of foreign ownership, but I can comment on this, the PE private equity side of RDA, which have invested in that Platinum Invictus entity. Now, whom we are allocating this stock. Now, them as well as, like I said, Warburg Pincus, they're really a phenomenal global name. So what this does is actually it gives 2 things to us. Let me just tell you that, Lata, these people are really high quality investors. They see everything. They invest only in companies with really good governance. When you can't raise a question on the governance, they are very long-term focused and very, very professional. I've dealt with them for a long time, like super professional. So what happens is that when you get that kind of capital, then we are at total peace of mind. I can focus on the work. I can focus on building a good bank. And then value will get created.
Yes. Okay.
I want to just add one thing that, in my opinion, broadly speaking, to create long-term value, you really will need a product which customers love. It's really important. And, a brand which attracts. IDFC First Bank has become one such brand. It attracts today. And, products are really superior and strong unit economics.
Okay. A final question to you. When Warburg first came in, I think 2012 in Capital First, and by the time they exited, they made, as you said, 9x. What have you promised them now?
I promised them lots of things. I told them they'll make lots of money. Okay. So, and I really believe it can be, because let me tell you, Lata, that the first 5 years, a lot of people sometimes say that, look why they are, your OPEX is high or your cost income ratio is high. It is high. I don't deny it is high because of the liability franchise, credit card franchise. But I tell them that phase 1 was setting up the bank. Phase 2 is operating leverage. Phase 2 is profits. Phase 2 is return on equity. And I have indeed suggested to them, let me say, nobody can promise anything, but I have definitely, like in my own way, told them with a lot of confidence that they will make lots of money.
You said 20% CAGR. So should we say you double the bank in 4 years?
Definitely, I think so.
Okay.
I mean,
all right.
think of 20% and I believe that our profit after tax will outpace this growth. This is my belief. I mean, our numbers are looking like that. This year, by the way, has been a bad year for us because of the microfinance impact on us, and I take responsibility for that. I'm the leader. So think of this year like we had a massive turnaround in our PAT from the bank. We took it off from the loss position to profit. It was supposed to go up. It came down. It happened to us. But we believe from 26 onward for the next 4-5 years, you should expect good numbers on this bank.
Okay. Thank you very much, Mr. Vaidyanathan, for speaking to us. We will look forward to more searching questions and answers after you announce your numbers, your Q4 numbers. Many congratulations yet again for getting some marquee investors in.
Thank you.
Okay. So there you have Vaidyanathan now coming with the more granular details in terms of their capital adequacy, now going to over 18%. Of course, it will be immediately dilutive, and maybe that little bit of red is seen on the stock. But, capital is big raw material for banks. So you would grab it with both hands when it comes.
Well, and this is an additional factor, for the banking stocks itself, because you have a big name coming in there. They're showing you $1 billion or thereabouts, so it's a positive rub-off as well, besides valuations and the likes. And besides what it's doing to that particular bank, which in this case it's IDFC First Bank, but someone writing $1 billion check is showing the kind of confidence, which is good.
Absolutely. At a time when things are otherwise wobbly, to detect and say this is a domestic-facing industry in a country which is showing like steady 6 to 7% growth, I think, clearly it's a morale booster for the sector as well.
Okay, all right, absolutely. Thanks for that, Lata. IDFC First Bank making headlines, and the clear takeaways: you're getting 7,500 crores in equity capital, 15% dilution, but the capital adequacy ratio goes up to almost 19%, as Mr. Vaidyanathan mentioned. Well, let's stick with banking, actually. There's so much of news flow right now. We're discussing, of course, the details and the fundraise at IDFC First Bank. And yesterday, it was actually IndusInd Bank which was hitting the headlines. The company now has declared that the external audit has found the 1,979 crore rupees discrepancy in its derivative portfolio, which is, of course, a little less than what was earlier estimated. Sources have also been telling us that the bank could perhaps see 3 senior-level exits as this matter is finally put to rest. So, I mean, where does this leave investors when we are talking about, some of these, I shouldn't call them really corporate governance issues, but let's say niggling worries that have emerged. I mean, IndusInd Bank being one of the examples. Hetal Dalal, President and COO of Institutional Investor Advisory Services, is with us. Hetal, thank you very much for joining in. So, just to sort of go over the IndusInd Bank example, what does it tell us? Where does it leave us? This derivative discrepancy came out of nowhere. The bank chose not to immediately disclose it, which is why the stock nosedived when they finally did tell the exchanges. And I believe that happened after some RBI nudging. And that is where the issue of investor confidence came about. Now the external audit has happened. Financially, there's not much impact, but it does leave a strange taste in the mouth, doesn't it, when it comes to investors and just clear disclosure?
That's very true. Good morning, everyone. I think the fact that this came as a surprise, it was a delayed sort of announcement given from when they figured it out to when they actually announced it to shareholders. It does leave open questions as far as investors are concerned. I think one of the things we keep telling companies, in terms of trying to build trust with investors, is to be consistent communication. Bad news should be delivered faster than good news. And you need to keep investors in the loop when some of these things are happening. Coming down 9 months after, almost at the close of the year, and then saying that all of this was, we found these discrepancies, indeed will leave investors open to thinking about whether there are more issues or not. I mean, at this stage, this issue seems to have been sort of capped. The numbers are out and the loss will be taken in the financial statements. But I think going forward, there needs to be a greater sensibility around communication and being consistent in its approach as far as investors are concerned.
No, I mean, obviously, IndusInd Bank went through a serious amount of price damage, Hetal. Do you think the worst is behind? And, how should investors look at it? Because on one hand, I mean, the analysts will argue about good value. It's a great asset, perhaps good business. But then all this and perhaps impending management changes. We need to know what's the succession plan, what happens after Mr. Sumant Katpalia. Our reporters are telling us that there could be some other heads rolling as well. So from that standpoint, what should investors be doing?
Yeah, look, I think the CEO succession and the fact that Mr. Katpalia is on his way out was news that came out earlier. So everybody knows he had a 1 year, 10 years. I mean, he has a short window in terms of succession. I think this is clearly something, this entire episode of the derivative book would have worked RBI for sure. And there will be heads that will roll most likely. I think what we're going to expect going forward in our view is that while this issue seems to be curtailed, and I don't expect there to be significantly no news, when you do see a new leadership, typically what you see is a little bit of a cleanup of the balance sheet. The new leadership will always want to start on a clean slate. It's called the big bath. In banks, though, they tend to be well governed, and there are significant sort of checks and balances. Some of these things keep cropping up. I don't disagree, but the quantum and the impact is not as high as you would see as we've seen otherwise in in other companies which are not regulated by or are not in the financial services. So I think by and large, this issue I would say is put to rest more or less. Will we see more issues? When the leadership changes, you're likely to see some, but we don't expect it to be significantly material. That's what I would look at.
All right. Okay, Hetal, thank you very much for joining in and giving us some perspective and clarity on this development. Hopefully, we won't see too many of these because they end up creating a fair amount of uncertainty for shareholders. Thank you for joining in. We'll take a quick break on that note, come back on the other side, and we'll have Ben Powell of BlackRock Investment Institute joining in on Trump tariffs and the global uncertainty.
Welcome back. Well, the good news is the markets have recovered all of the losses. We're almost moved into the green. And as we said earlier, the Nifty needs to move higher. The Nifty Bank will have to do bulk of the heavy lifting because the IT index is under the weather today. And as we speak, the Nifty Bank is now up close to around 400 points, building onto its gains. And it's only approximately 2% away from an all-time high. So good going on the Nifty Bank. Ben Powell, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute, joins us on the show. Hi, Ben. Good morning and good to see you, Ben. Well, what are you making of the news flow? There's hope that there's going to be some kind of rationality that will come about. President Trump, as well as the Japanese, are having a discussion. A lot of comments coming in from the Chinese as well. And then you have news that various parts of America are looking at suing President Trump because of these tariffs. So a lot of news flow. Do you think things will get better from here on? Rationality will come about and the world moves forward?
Good morning. I think rationality is a high bar. I think we live in an emotional era. President Trump has talked extensively about how he feels for many years or decades America has been exploited by the rest of the world. And now, to some degree, it's payback time. So I think there's more to life than pure rationality, and politics inherently is somewhat emotional. So that's normal, and that's going to continue. That does confuse our lives in markets where we are, kind of always looking for a pure, clean, quantitative answer. It's going to be messier than that. We did think at BlackRock last week was very important, specifically where it seems that there are some constraints on the US administration. So they were, I think, a little bit worried by, in particular, the move higher in US Treasury yields. That, I think, was disconcerting to them. And since then, we've seen them adopt somewhat more of a positive approach bilaterally, as you're saying, including with big countries like Japan, India to come soon, we'll hope. So I think there are things to be more positive about. There is a constraint, which is good to know, but I don't think we're going to have a purely reasonable kind of market or economic backdrop, because it's a time for kind of passion, and I think that's going to continue.
Oh, absolutely. I mean, we're still watching for all of those headlines and those social media posts, right, Ben? This morning he says that it's been, I think, a great meeting with the Japanese delegation. So let's see what the eventual outcomes will be like. But from a market perspective, first basic question, Is the worst of the price damage over? Has a floor been put in place around global markets, equities?
So we're overweight the US, and the US obviously is the huge bulk of global equities. So if you don't mind, I'll speak to the US as an answer to your question.
Yes.
Yeah, look, we think there is something, as I mentioned last week, was like very important. That Trump, who has signaled, I think, that he's much more interested in Main Street than in Wall Street. Yeah, that was very worrying for equity markets. But he is constrained, it would appear, by the bond market. So I think that was like really important information that we got. That's the first thing. The second thing is there's still a lot to be positive about at this time, including the AI megaforce, some earnings growth stories that we favor. So, you know, again, a lot to worry about, many things that are for sure kind of uncertain, but we shouldn't throw the baby out with the bathwater. There are still significant tailwinds that are out there, and we need to remind ourselves of that before we all become a little bit too emotional ourselves, I guess, and too kind of worried about the bad things, of which there are many, but there are some good things as well. So in conclusion, we actually, we're overweight US equities. We think valuation is sufficiently cheap now that we can start to carefully pick our spots as to where we want to be more positive. And again, AI continues to be a very powerful tail force, we think, and clearly America and other markets, but in particular America, is a way to play that.
All right, so Ben, you're saying that you'll stick to the US markets. You know, what commentary we've been hearing over the recent past is the dollar index got a little bit more weaker. Trump still has the problem with regard to deficit, so something's got to give out there. So we could see some money flowing to emerging markets. But you're saying that you still believe that the US market will outperform even from here on. Is that correct?
We're overweight the US, that's true. But I think implicit in your question, Nigel, is something super important, which is that we are moving to a much more fractured world, sadly, I would say, but that just seems to be true. And as investors, we need to reflect what's true rather than what we maybe would prefer to happen. So what seems to be true is the world is fracturing geopolitically. And as investors, that should mean less correlation in equities markets in particular. So in the calmer times, you could just be so-called risk on, right? You could sort of just buy the S&P, and that was a proxy for global risk, and that was sort of sufficient. Now, we think you, as investors, we're all going to have to be a lot more granular, a lot more kind of specific in exactly what risks we want in the portfolio. And that includes certain geographies outside of America. So I would highlight Japan as one. I'd highlight maybe India as another. But the broader point is, yes, we still like the US, but in a fractured world, we're going to need to be kind of more expansive and think beyond the US as to particular areas of the market, the global market, that we think can do relatively or even absolutely okay as part of this fractured, more fractured world.
Interesting. So you have to diversify risk, basically, and look at some of the other markets as well, like you're saying. Ben, on a side note, I mean, gold has been such a stellar show this year, right? I mean, if you look at the targets, I think most of the big Wall Street banks, they still have targets northwards of 3,500 USD. I saw one, I think it was Goldman Sachs, saying 4,000 plus. Do you think gold will still keep drawing in this kind of fund flow?
I think so, yes. I mean, look, gold has got a 6,000-year track record of being the diversifying asset, maybe all the time, but particularly in times of uncertainty. And heaven knows we've got one of those right now. So, yes, it does feel like a time for gold. We'd only want to have a certain proportion of that in the portfolio. So, you know, again, obviously at BlackRock, the world's largest asset manager, we would always sing the song of diversification. I think that's like very important. But as part of that, gold continues to do well. And I think, again, over a very long period of time, the benefits of having some exposure to gold as part of a well-diversified portfolio, in particular during volatile moments, I think are well established, and we think that's going to continue. So yes, a lot of merit for gold in the broader portfolio.
And speaking of diversification, you mentioned the bond market, right, which I think finally forced the U.S. president's hand. That little drama that played out that finally perhaps made the U.S. administration back up a bit. Was that just a one-day event? We remember that surge, right? U.S. 10-year suddenly was shooting up to 4.5%. Conspiracy theories about whether China is selling treasuries or Japan is selling treasuries. Do you expect more of that? Because that's where markets really get rattled.
We expect more of that, yes. I think we're in the midst of a global rate reset higher, driven by inflation, which, as Chair Powell was saying overnight, continues to be much too high already. And that's before the inflationary impacts of tariffs start to feed through. So we're likely to be moving into, indeed, at BlackRock, we would say we are already in a structurally higher inflation environment. That has implications for the Fed. Simply put, they can't come in and save the day. And then to your question, that also has implications for longer term interest rates, which we think should, over time, move higher. So you're exactly right. We had a particularly kind of exciting, dramatic moment last week, which for sure we need to focus on. But it's actually a bigger story than that for us at BlackRock. It's a part of a structural trend higher in interest rates, driven by higher inflation, which we think is going to continue, and actually is only going to be exacerbated by the tariff, the inflationary consequences of tariffs.
All right, Ben, I want to ask you, what do you make of Powell's statements overnight? You know, he said that they've got a tougher job than they were earlier thought about. And did he put to rest any kind of Fed put? What was your reading of what he said overnight?
Yeah, I think so. Look, I thought he spoke truth, right? He said, look, inflation's a bit high. I'm going to paraphrase here, but he said, look, inflation's a bit high, and that's a constraint. So the Fed has a dual mandate. And I always want to be really clear. Mandate means mandatory. It means they don't have a choice. Their mandate is given to them by Congress, and they do not have an opt-out clause, right? It's mandatory. And the dual aspect, one, kind of employment growth, two, inflation. So Powell, I thought, was just reminding us of that. And therefore saying, look, the inflation side is already a bit high. Tariffs are inflationary. That's a non-political, non-controversial statement. That's just true. And therefore, the Fed is going to be somewhat constrained in how much it can come in and bail us out if there is a growth or market problem. So there is a Fed put, but the strike is probably a lot lower than we would all like. And we are not close, I think, to that Fed put. So Powell, I thought, spoke very well, very clearly, as he tends to do, reminding us about the binding nature of both sides of the mandate, and in particular inflation, which is just too high and potentially going higher as the ramifications of tariffs work through.
You're saying that you would not be surprised if U.S. rates head higher, inflation. How much higher, Ben? Do you have some sort of a range in mind, 10-year?
Yeah, so we think ultimately that it's reasonable to think over time that the 10-year can start with a 5 handle. That seems totally reasonable to us. And that is potentially a real kind of issue for a U.S. administration and a U.S. economy that's obviously got substantial amounts of debt. One kind of really interesting aspect of this, by the way, is like 30% of that debt is owned by foreigners. So it's quite an interesting aspect. You know, President Trump seems to be moving towards, as he said many times, an America First policy approach. You know, sure, that's fine, but it's also true that 30% of your funding comes from foreigners. So I'm going to be very interested to see how the U.S. administration squares that circle of being, as they've said, America First, but I guess also being somewhat friendly for the overseas funding, which has been such an important part of U.S. growth and exceptionalism, I think, over the last many years and decades.
Well, indeed, Ben, it's going to be very, very interesting with regard to how he rolls over as well part of that debt at a higher interest rate, and as is they're running a big deficit number out there. So interesting times. We'll keep an eye out on the markets, but also I think the bond markets, they deserve special attention. Thanks a lot for joining in. Always appreciate your comments here on CNBC-TV18. Well, time before we slip into that break, let's get Mitesh back in. Mitesh, welcome back. Well, that buy the dip is working out yet again. We were down 130 points. We've pulled back a little bit. And the Nifty Bank, that's rock solid, right? Just thumping ahead as we speak. Your view?
So, Nigel, I think the bias and the directional structure remains on the positive side. And therefore, I think, you will see declines or profit booking pullbacks being bought into. I have chosen, in fact, IT stock, given the fact that IT was sector going through bad news, and yet I think there is OFSS, which is now trading near yesterday's close and near the day's high. So buy here the stop just below levels of 78.10, which is just below today's low as well. And we will look at targets of around 8,100 to begin with, maybe more, but that's the first target. And SBI card is a buy as well, with the stop at about 875 for targets of 920.
Okay, got that, Mitesh. Mitesh, just on, some of the financials, because that clearly is the strongest part of the market. Apart from, say, an ICICI Bank, which is the index leader right now, anything else? I mean, what are the other broader trades that you would want to take in either banks or non-banks?
I think banks is, of course, one of the safest sector in the sense that the chart structure is one of the most positive over here. Though I think the only worry is that now the banks are reaching 53,800 level, which is where we had the highest weekly closing. It was 53,834 on the 27th of September. So maybe, when you reach a previous high, you will see some profit taking place. So around those levels, I would suggest taking some profits off the table. But otherwise, it remains a sector to be in. That apart, I think, stocks like Adani Group stocks are looking very positive to me. The insurance stocks like HDFC Life, LIC of India, and ICICI Pru also look very interesting in the short to medium term chart spaces.
Okay. All right, Mitesh, we'll leave it on that note. Thank you very much for joining in. I'll take a break right now. Come back on the other side. We'll get you the latest from the commodity markets.
Welcome back. Well, the big boy HDFC Bank has made a fresh 52-week high. I think that should come up for you on the screen. In December, it had gone all the way to around 1,880 rupees. And today it surpassed that, almost at 1,900 rupees. So HDFC Bank is now making a 52-week high, while the Nifty is still a good 10% away from that mark, 10 to around 11% or thereabouts. So the big boy has found its form yet again. But let's talk about a couple of earnings reactions. And Angel One, that's under pressure. Remember, the stock has pulled back a goodish bit from the recent peak, but quarter four numbers were disappointing. Upasana joins us to fill us in with a quick analysis. Upasana?
Well, the company has reported a weak set of numbers. It's a sequential miss across the board. Now, high operating expenses led to the decline in the margins and profitability, and company's cost-to-income ratio stood highest in Q4 this year at 71.6%. Now, in terms of gross client acquisition also, it saw a degrowth of as high as 22%, and it slowed down sequentially as well. Now, 30% is what we saw versus in the last quarter. So, if we compare sequentially, it is a big degrowth. Now, total client base also saw an uptick of just about 5% sequentially, and market share also saw a dip in equity, F&O and commodities, while there has been an uptick of nearly about 10 basis points in company's cash segment. Now, coming to the numbers, now revenue saw a downtick of 16%. This was mainly impacted due to 21% fall in the company's net broking income. Order volume, which is the key revenue driver, fell nearly about 23% sequentially, and EBITDA margins, as stated earlier, were under pressure, are down nearly about 680 basis points at 32.5%. PAT also saw a downtick of 38%, and company's average daily turnover also declined 19.7%. Now, company says that FY25 performance subsums regulatory changes and even softer market conditions. So all in all, weak set of numbers from Angel One, and we can clearly see the stock price.
Okay, all right, got it. Upasan, thanks very much for that. Let's move back to IT now. IT obviously is taking it on the chin, the sector of the day for all the wrong reasons. Rima is back with us. Disappointment from Wipro and now nervousness about Infosys. Rima?
Indeed, and now the Nifty IT index is down 25% year to date, underperforming the Nifty itself by more than about 20%. That said, the IT index is still about 5% away from its 52-week low that it hit on 7th of April. For starters, Wipro is the top large cap loser after the Q1 guidance disappointed at minus 3.5 to minus 1.5. Then you had Sonata issuing a revenue warning for Q4, saying that the revenue that they were anticipating from the largest client will be lower than estimates. And some analysts are saying Sonata's Q4 revenues could actually decline in high single digits. As you said, there is nervousness now. What Infi will do? Will they guide or will they not? Given the uncertainty, will we see an FY26 guidance from Infosys? And if we don't, that means the uncertainty lingers on for the next 3 months. So far, if you remember, both TCS and Infi have missed the mark on the top line. Revenues for both the companies have fallen in the March quarter by 0.8% quarter on quarter. Both the managements have highlighted that there is cautiousness in the air. They are taking a wait and watch approach. Wipro said the clients are taking a measured approach when it comes to large transformational projects or discretionary spending. And there are some delays, some projects which are being put on pause, some decision-making delays. And finally, I'm just going to put up the IT calendar for you up on your screen. Today, it's Infi, Tata Elxsi, but over the course of the next 1 week, we'll have numbers from HCL Tech, LTI Mindtree, Cyan, LTTS, Emphasis, Persistent, Tech Mahindra. Basically, the entire picture will be clear, by the time next week ends. Back to you.
All right, Rima, thanks very much for that. So awaiting more IT numbers then. Let's now talk about the commodity markets. Let's see what's the headline with Manisha. Manisha, I was about to say happy Friday, but it's a happy Thursday. We're getting ready for the long weekend. What's the latest?
Well, ahead of the long weekend, especially, and it's not just for India, but most of the international markets as well. And we've seen some more buying come in for gold. Overnight, we've seen stronger gains in the Asian markets right now. We're trading at 33.57 of an all-time high yet again for gold. It's come off slightly, trading at 33.40 at this point in time. But in the overnight markets, we've seen 3% of gains come in for gold. And that's a report card of what we've done till now. On a weekly basis, we're up 4.5%, up 10% on month. And for this year now, we're up 27.5%. And if you look at the last 12 months in case of gold prices, it has given you a 41% of a return. Also, when you look at it on a year-on-year basis, as I said, for this year until now, we are up by 27%. Last year was 28% of gains. So even as we are into the 4th month of this year, it's almost an equal kind of gains that the gold prices gave you in the previous year as well. 2023 was 15% up. So the last couple of years clearly are doing very, very well for itself when it comes to gold. Well, gold has posted 25 all-time highs in 2025 till time, and it has posted 13 all-time highs above $3,000 an ounce. So clearly the distance that we've seen covered between 2,000 to 3350 has been the fastest that you have seen gold ever do in the history there. Well, it has been about escalating US and China trade tensions that has been supportive. It also has to do with Nvidia warning of all impairment in the first quarter, talking about $5.5 billion there because of the kind of tariffs and restrictions that are coming in trade, especially between the two countries, which is US and China. And then US also has ordered probe into possible tariffs on critical mineral imports. So this uncertainty, these concerns is what seems to be really getting in more safe haven money in case of gold there. The markets also are reacting to the US dollar index continues below 100, which is a 3-year lows for that currency there. And then there's a huge amount of ETF buying, which has been supportive. You know, between the months of August to November, perhaps ETFs were redeeming. But if you look at the first quarter of 2025, the ETF inflow has been the highest in 3 years at around 226 tons. Now, this is what tells you on how the global ETF markets have seen tonnages in sense of gold there. So Jan, of course, started with 34.5 tons. But Feb and March have seen more than 90 tons per month go in. And the expectation is that month of April seems to be doing quite well as well. Well, the markets do believe that the momentum is still on the higher side. Gold prices can continue higher, except if you are looking at very strong central bank buying as well. In this year until now, we've done 44 tons. And if you look at the previous few years, 1,000 tons per year is what the global central banks have bought. 2022 was a record 1,082, and since then, we've continued to hold above these kind of levels till time there. The markets believe that, as I said, momentum is still on the higher side, and any profit-taking as and when it comes would be only after we hear some positive cues coming in from US and China in sense of trade talk development. Until then, you could be looking at higher highs.
Okay, all right. Thank you very much for that, Manisha. So gold continuing to sparkle. Well, we'll take a break on that note, come back on the other side, and it's our special segment. It's the economy. Lata today discusses details with Rikin Shah, who is the banking expert at IIFL. He talks about whether bank margins have bottomed out.